Two people walk into the same market. They see the same house, the same stock, the same business opportunity. One asks a single question: is this cheap? The other asks a different one: is this the right time? Years later, their outcomes look nothing alike. Not because one was smarter, not because one worked harder, but because they played a different game. Most of us are raised with one financial rule: buy cheap, avoid expensive. It sounds responsible, it sounds safe, it sounds smart. And in daily life, it often is. But investing doesn't reward cheap, it rewards positioning. And this is where the thinking gap begins. Price is a single moment. Timing is a sequence. Price asks, how much does this cost right now? Timing asks, where are we in the cycle? Rich investors don't ignore price. They just know it's incomplete information. Imagine someone buying a phone. Person A waits for discounts. They want the lowest price. Person B buys early, pays full price. Who made the better decision? Depends. If the phone helps person B start a business, increase productivity, create income, then timing beats price. Cheap would have cost more in the long run. Now scale that thinking to real estate, stocks, businesses, education, relationships, even careers. Timing compounds. Price does not. Rich people don't see money as something to protect. They see it as something to deploy. Idle money is risk. Waiting is a decision. Delay has a cost. So instead of asking, can I get this cheaper? They ask, what happens if I wait? Waiting feels safe, but it's rarely free. When you wait, you risk missing compounding, entering later at higher prices, losing momentum, losing confidence. Most losses don't come from bad decisions. They come from late decisions. Let's make this concrete. Investor A waits for the perfect price, wants confirmation, avoids uncertainty. Investor B invests early, accepts volatility, stays invested. The market rises. Investor A says, it's too expensive now. Investor B is already inside. By the time Investor A feels safe, the opportunity is gone. People say the market is too expensive, but expensive compared to when? Last year? 5 years ago? 10? Most assets look expensive before they grow. Amazon looked expensive. Apple looked expensive. Real estate always looks expensive. Until it doesn't. Here's the uncomfortable truth. The best timing opportunities feel unclear, uncomfortable, risky. If it feels obvious, it's usually already priced in. Rich investors step in when sentiment is low, fear is high, patience is required. Not because they enjoy risk, but because they understand cycles.
Markets move in cycles: expansion, peak, contraction, recovery. Most people buy near peaks. They feel confident then. Rich investors buy closer to bottoms. They feel uncomfortable then. Same asset, same price range, different timing. In real estate, beginners ask, is this house cheap? Experienced investors ask, where are interest rates? Where is population moving? What happens in 5 to 10 years? They buy before demand arrives. By the time it's obvious, price no longer matters. Timing already won. Timing requires patience, uncertainty, long-term thinking. Price feels measurable. Timing feels abstract, so people default to price. But money rewards foresight, not comfort. Here's something subtle. Rich people are comfortable being early. Poorer investors want to be right. Being early looks wrong at first. Prices may fall, people may doubt you, but timing isn't about being right immediately. It's about being right eventually. Education as an investment. Think about education. That course is expensive. If I delay, what does it cost me? Skills gained early compound. Skills delayed shrink opportunity. Timing again. Early decisions don't just grow money. They grow confidence, experience, access, networks. These things don't show up in price tags, but they create future leverage. Discounts are backward-looking. Timing is forward-looking. Rich investors care less about saving 10% or getting a deal. They care more about positioning early, staying invested, letting time work. They know the biggest gains don't come from bargains. They come from duration.